welcome to today's session on the budget. This is Anup Bansal from Mitraz and Scripbox. We have with us Mr. Rahul Singh, CIO, Equities, Tata Mutual Fund, and Prateek Mehta, Chief Business Officer, Scripbox. Though every budget is a highly anticipated event for corporates, individuals, and foreign institutions, and listening to budget can be a roller coaster ride, this time it was truly different. The world and India are still recovering from the pandemic last year. Economies have been badly affected, jobs are lost, and tax revenues have been impacted. As usual, everyone was guessing. Would the government bring in wealth tax, COVID cess? Would there be enough measures to boost the economy? Markets have recovered well in the last 9 months. But what signals the government will be sending to the market? Well, the budget is out, and market has given a thumbs up with indices going up more than 8% in the last 3 days. In today's session, we will highlight some of the measures and what it means for the investors. You may visit our website, scriptbox.com, and download the app for our views on the budget. While we can get lost in numbers when we talk about the budgets, what 2021 budget shows is the intent. The intent to put a plan in place to be a $5 trillion economy in the next 4 to 5 years. I recall 1991 foreign exchange crisis when we had only 2 weeks worth left for imports, and we responded very well to the crisis. This time also it has happened, the same has happened actually. India always responds well to a crisis. Recent example is the GABA test in Australia, which will be etched in everyone's memory eternally. We could have taken a very cautious approach, but the budget has put trust in the entrepreneurial energy of the nation and the vision to achieve or to more than double our GDP. The proof of pudding will be in eating, but there's an optimism and effort to unleash the animal spirits. We will discuss some of the associated risks, so please stay till the end to know what are the implications for you as investors. So to start, may I invite Mr. Rahul Singh, to talk about what are the short and long-term implications of the reforms or the budget announcements this year.
Thank you, Anup. Yes, I think, as you rightly said, that budget was, a positive surprise, and in times of adversity, it was made even sweeter. In fact, to summarize the budget, since you mentioned the GABA test, I would like to say that in this budget, government has batted like Pujara, taking all the blows while allowing the young economy like Rishabh Pant to score freely at the other end. So it was truly like that, because I think the government has, for the first time, made their intention clear that they are going after growth, and they are going after growth in a big way. Could they have done this 2 3 years back? Yes, they could have. But I think what is helping them is that COVID situation and adversity is bringing the best out of them. And I think the short-term implication of this is that, one of the reasons we were worried about the market levels was also because it was all led by FIIs, and the flows from the foreign institutional investors had been very massive in the last 6 months. So there was always a doubt that can it sustain. Now, what this kind of a budget does is to bring the belief back in the investors that the long-term growth potential for India, or the medium-term growth potential for India, will be realized. And we should not become like a country where the growth potential always remains on paper, and we never realize that growth potential. And I think for that, this budget will go a long way in at least trying to achieve that goal. And I think that is one implication, that I see the FII interest or the foreign investor interest to be continued, and I think the flows will sustain. Beyond that, I think from a fundamental perspective and the corporate earnings perspective, clearly there were some sectors which were doing well, like IT, pharma, telecom. Even in the times of COVID, these sectors were doing well. But the sectors which were not doing well, or have not been doing well last 5 7 years, like investment capex cycle led, or industrials or banking, I think this is a budget which will bring back the investment cycle, because traditionally our market has been known as consumer driven consumption, consumption, consumption. And we had forgotten that there is something called an investment cycle also, which we need to take care of. And I think successive governments lost track of that, or however hard they tried, they just could not get enough things going. Again, I think COVID has changed that, because in India, um, post the anti-China sentiment, I think there is a genuine interest from all kind of corporates to set up capacities in India and set up manufacturing capacities, reasonable size capacity in India. So that's the long term or the medium term impact of a budget like this. So short term is more on flows and reviving the investment cycle. Long term is that, can India really become the global hub for manufacturing? Can India take some market share from China? Because we lost the first wave of manufacturing boom between 1990 to 2010, because we didn't have our act together. We were focused in software and pharma and so on. We never focused on manufacturing exports as a big theme. Now we are getting that opportunity. I would say it's a once in a decade opportunity. And I think part of the reasons why you see the things you see in the budget is also because government wants to capitalize on this opportunity from a 5-10 year point of view. So that's the real, I would say, the long term kind of advantage or long term implication of this. The other long term implication, before I uh, finish, is the PSU as an asset class, public sector enterprises. There has been a lot of talk about their inefficiencies, them being value destroyers, and so on, and all rightly so. So for the first time, you're seeing a government which is saying, okay, over the next 4 years, you're going to have privatization as a recurring theme. We started with a couple of companies, but this is not a one-off exercise. It's going to be a long-term kind of an exercise, where every year you will see 2 or 3 large companies getting private. I think it's a very, very strong move, especially when you say that you will privatize 2 PSU banks. It's just unthinkable a few months back that the government will do something like this.
I think the whole capital expenditure that they have gone up, and while reducing the revenue expenditure, while keeping the 34 lakh point some crores kind of the outlay being the same, but capital expenditure going up significantly, or at least more than 25%. And there's a kind of a statement that yes, we are serious about investment cycle and making sure that the growth comes, and also taking care of or addressing some of the concerns, whether it's your bad debt problems which may be there in
Right.
the economy, right? Stress assets. So also putting some kind of framework around those things is also kind
Right.
of very helpful, because it gives the right kind of signals for the long-term growth, right?
Yeah, it is quite a comprehensive, well thought out budget in that sense, because you're trying to privatize PSU banks, but nobody's going to buy a PSU bank with a lot of bad debts. So first you
Exactly.
clean them up with an ARC, buy their bad debts, and then privatize. So it's a. I mean, you're trying to attack the problems from various reform measures, and because if the economy has to grow, the credit growth has to be there. So you can't survive just on 4 or 5 private sector banks. The public sector banks also have to become healthy and start lending.
Right.
Rahul, one of the points that historically has come by is that this export-led growth engine, we've governments have talked about it, articulated the aspirations, but somehow we've always fallen short. And I really like the point that you touched upon, that this is a once in a decade opportunity, right? That there is a shift happening from China, and can we establish India as an alternative of sorts, right? What do you think? So, how are the stars aligning now, and what are the specific steps you see coming in right at this point in time?
So the most tangible step is obviously the production link incentive scheme. Now, if you look at the production link incentive scheme, it is not, it is linked to the scale of the investment. So you're not trying to promote some small enterprise trying to get benefit out of just exporting. Earlier, the export incentives used to be as a percentage of exports. Now you're saying no, this is the cutoff investment limit, and you will get, if you commit certain amount of investments, you will get incentives. So there is a subtle shift that it is trying to promote large scale investments, and they have focused on 13 sectors as of now. I think it will keep expanding. So they want to identify some champion sectors and then focus on building large scale investments. And also, what interesting thing they are doing is that they are focusing on, in this PLI scheme, they are focusing on the downstream investment, which means, let's say, the final assembly line or the final product, but not on the intermediaries. Because once the products come, the intermediaries, that the whole supply chain will also get established, and the investments will come there also. So what you see in production link incentive is only if it really is successful, and so far the early signs are very good. It's been, I mean, all the corporates are talking about it. All the companies which we speak to, they are very, very excited by this, and across sectors. And once that kicks off, then there is a trickle down effect on the supply chain investments also. So it could become a multi-year thing, like I said, and some of the companies have actually done very well, but it's just the beginning of that process.
No, I agree. I think in some sense, this is a budget that is really thinking of putting the basic foundations in place, right? Whether it's the PLI piece or even the clear intent of improving the entire supply chain in country, right? With freight corridors, with uh,
Right.
focus on building more road infrastructure. I think all of that, given that logistics costs in the country has historically been very high for a lot of companies, and if you can meaningfully bring it down, right, whether from a port to factory or vice versa piece, I genuinely believe that we can possibly unlock 1 to 2% in terms of net margins, and that can be a massive enabler in unleashing the animal spirits as far as the corporate India is concerned. We've been
That will also make sure that you don't kind of run inflation risk, or at least you keep no, the prices under check, right?
Yeah, no,
You
that's
become
important.
become more efficient actually.
Yeah, no, that's important, because every time you look at our history, every time consumption picks up, the inflation suddenly shoots up. So we've never been able to control inflation because supply side has always been lacking. So, like I said, our economy, and I think equity markets are uh, partly to blame, because we've been obsessed with consumption as a theme, and therefore what happens is capital allocation has gone to consumption and away from investment. Whether you look at equity, at least equity capital allocation has been moving away from investment for a long time. So this will change that, and because if you don't do that, we'll never achieve more than 4-5% GDP growth rate. See, if you have to achieve 7-8% GDP growth rate, if you read the economic survey, which is our potential growth rate, then you have to have investment cycle up and running. Otherwise, you will grow 1 year at 8%, inflation will go up, interest rates will go up, and then you're down to 5. So it's just a stop start kind of economic growth is not going to pull such a huge amount of population and create jobs for them on a sustainable basis. So I think I hope that the government is also thinking like that when they announce this budget. I think they are right now, and I think that, to me, that's the most interesting message from the budget, that finally they have realized that they need to do something about creating jobs, creating investments, because otherwise, if you let things drift, then we will only drift down. We'll not drift up. Nobody drifts up.
yeah,
We always drift
Correct.
down only.
sure.
So, Prateek, what do you think are the sectors that we can look out for, and what will be the economic recovery plan? So,
So
according to you.
So the way I look at this, Anup, is that especially over the last 12, 18 months, we've seen a bit of crisis of confidence in the country, right? More at an individual level. And if I talk to companies and uh, players, so there clearly has been, at an individual level, people have been more conservative, whether it's for their consumption decisions or their long-term aspirations, they've tried to be a little more conservative around it because there was a sense of insecurity around whether their jobs or other sources of income. And similarly on the corporate side, especially on MSME side, etc., I've seen that the desire to invest in the future, offtake of credit, etc., all of that had suffered for a while. I think this, as Rahul pointed out very clearly, was that yes, government is definitely creating that point where the economy can take off, and I'm hoping that that at a personal level and at the industry level, that spirit is more or less unleashed, wherein people can start taking a more long-term point of view with a sense of more emotional security, right? In terms of sectors, I think there's been a very clear, as Rahul talked about, whether it's the PLI piece or the intent of establishing large textile parks to go back to the heritage of Indian success in the past in textile spaces specifically, or whether infra, roads, all of those, even healthcare. Frankly, for a country of our size, the public healthcare infrastructure, rather the healthcare infrastructure itself is fairly weak. The number of doctors that we have in the country is per thousand people is significantly lower than the global average or the best, right? The European nations have close to 4.9, close to 5 doctors per thousand people, and in our country we have less than one, right? So I see there's a lot of long-term view that the budget has taken, and a lot of the statements which were in some sense heartening were also 3 to 5 year horizon, which kept coming in, right? That it's not necessarily this year. We are reiterating our commitment from a long-term perspective, which I think is a great indicator, because if there's a continuity in policy, that is definitely something um, that across sectors, across uh, specific areas of economic activity, people can take home, start planning their long-term outlays and investment cycles accordingly. Yes, there's always a risk that yes, right now there seems to be a clear commitment that the 3 to 6 year horizon and those multiple such statements were made during the budget. Yes, that risk is there from a long-term perspective, because some of these intents can change over a period of time. But I really like the fact that there was a long-term orientation here.
Yeah, we see some of the things are ancillary. For example, when you improve roads, you also, in a way, help tourism, right? So when you are improving roads in road infrastructure, the tourism industry automatically gets some benefits, right? So there will always be some of these things, whether it's a real estate because of the labor intensive, some of the sectors that will get benefited, and the health sector that you mentioned about. Rahul, any other sectors that you think that which, in your view, would be benefited with this budget?
Yeah, I think all the cyclical sectors like cement or I would say construction, capital goods, industrial automation. Because I think, as I was saying, there is been a long 8 to 10 years when some of these companies have been starved of new orders, new projects, and they have really stagnated. And now we are seeing beginning of a new capex or the investment cycle in all three parts, mind you, which is government, which we saw in the budget. Private sector is beginning to put in some money on the ground. We saw some announcements by cement companies. We saw paint companies. We also saw obviously production link incentive PLI scheme is there. So I think private sector capex is coming back, and I think the real estate side, which was again sleepy for the last 5 7 years, I think that is also picking up, and I think that's important because a lot of jobs and a lot of ancillary industries are linked to real estate, and once that starts to move, then you have a different kind of cycle and feel good and wealth effect. So I would say that watch out for these industries, infrastructure, real estate, and as a result, the sector, which the large sector which will do well is obviously banking. Now, today we have seen only a few banks doing well. We could see, larger set of banks doing well. So all in all, I think these are the sectors which I would watch out for. Consumption is an evergreen story in India. IT and pharma are doing their own thing. They are growing not because of Indian government. They are growing in spite of the Indian government or Indian
And
domestic policy.
IT is doing well because all the digitization that is
Yeah.
happening right now is just kind of taken off in a
Correct,
big way.
correct. Yeah, and even pharma got help from COVID, right? I mean,
Correct. Yeah, absolutely.
suddenly Indian pharma is before. If you look at, it was always the US FDA used to look at it with a little bit of a suspicious eye. Now that mood has also changed. So a lot of things have helped India in COVID. Post COVID, we should not forget that. Globally, I think we are in a nice spot. So I don't want to really point out only one or two sectors. I think a lot of sectors are today. I mean, I am seeing that in the last 5 years, I have never seen so many sectors doing well at the same time. It's not happened. This is the first time I'm seeing it. So that is what, and that is visible in the equity markets. I mean, I don't really need to say that.
Market is already kind of giving thumbs up to,
Yeah,
to some of these, right? What are the long-term implications for the retail investor? So we were talking about some of the risks, right, which may be there. What do you guys think of the long-term implication for the retail investors, and what are the risks? So maybe Rahul, you can start, and then Prateek, you can join.
Yeah, I think the risks are.
Sorry to interject. For the viewers, if you have any questions, please type it in comments, and then we'll address those towards the end of the session. So just thought I'll let you guys know. So Rahul, please go ahead.
Yeah, I think the risks, Anup, are basically to do with inflation globally and domestically. Globally, if the inflation kind of shoots up disproportionately or suddenly, then there could be a rise in the interest rates globally. And whenever interest rates go up globally, especially in US, it will be negative for equity markets. I think this time it will be more negative for US and less negative for emerging markets, but it is still a risk. It's a risk we need to watch out for. And I think there are a lot of commentaries which indicate that the time frame in which that risk can come is around the summer season for the northern hemisphere or the US, because that is a time, probably COVID would have run down and you would be having an economy which is recovering. And whenever you see a economic recovery, that is a time you can have inflation rising its head. In India, I think inflation, more than inflation, which is obviously we need to watch out for, I think what we need to worry about is crude prices. I think one thing which can disturb India's story or really pull India down is if crude prices go up to $70-$80 and stay there, then suddenly our positioning kind of weakens. And that I think is something which we will we'll have to watch. I think these are the two risk factors which are difficult to quantify, but they are out there. I mean, there is a risk, and therefore there is a while we are all finding the economy and the boost from the budget being very positive, I think we need to be watchful of these couple of risks.
Prateek, what do you think are the risks?
I think apart from the points that Rahul had already pointed out, I think one long-term risk which I believe has to be mitigated for the India story is the human capital risk. I think as a country, our education system continues to remain inefficient. We have we don't have enough people enrolling for higher education, and even there, people who come out of the higher education system, often we see lack of employability, and that's where for industries and certain kind of industries, there's always been a certain scale beyond which expansion becomes a challenge. I think in some sense, this budget also addresses this risk in part because women can now work in night shifts as well. So I think just adds available labor pool and human pool which is available for economic activity. But I think that's a long-term risk that as a country we need to mitigate. And the other risk which was health, I think uh, great news in this budget has been increased outlay on health. I hope over the next few years this intent stays, and given the fact that globally all countries are going to continue investing for their future. I hope the government has the luxury for the next 24, 36 months, wherein some of these large systemic areas can also be addressed. Right now, I think there was a injection of confidence that was required, which has been given. I think the next one would obviously be how do we develop the long-term muscle for execution. Um, those are the only two areas which I believe are things that we need to watch out
So, so retail investors, I think they heaved a sigh of relief when there was no change in personal taxation, and there have been, I think, announcements which were very reform oriented. Whether it was about assessment, and what I understand is this whole faceless assessment is something which in the world is looking at India right now, because it's not been done anywhere else. So whether it's faceless assessment, whether it's like for 75 years plus senior citizens not filing income tax if they have only income, pension income and interest income. So there have been some some changes which were not number oriented, but they have long-term implications, right, for the retail like for retail investors. So what do you think, Rahul? We can advise retail investors about this budget and what they can do, what they should do.
And just adding a point there, Rahul, maybe it would also be of interest to know how people should manage risk at this point in time, because
Correct.
clearly there's a lot of um, positivity and ebullience in general, but how should people process it, right? Would be good to hear a bit on that.
Yeah, no. When there is excitement, there is always risk. Let's not forget that. So when Rishabh Pant is batting, you know anything can happen. So right now we are entering that phase, I would say, where we will see excitement in the market. I don't see kind of risks to the fundamental uh, story which India is spinning out, and I think with a lot of backing, but I think, as I mentioned, the risks are on the global front, more on the global front right now than on the domestic front. Obviously there are unforeseen risks always in the market. At 14,000, 15,000 Nifty and so on, and 50,000 index, there is always risk. In fact, in equity market, there is a famous saying that if the valuations keep going up, it doesn't mean normal behavior of an investor is that the risk is reducing because everyone gets comfortable. But that's the time when risk is actually increasing. So you need to be careful in managing your portfolios in a way that you are positioned for returns, but you don't get carried away, and you have core of your portfolio which is slightly more stable, which can give you steady returns, inflation plus 4-5%, or a fixed deposit plus 4-5%. So that should be 30-40% of your portfolio. So there are various fund categories which can help you do that, like the balanced advantage fund category. And then you take risk on the remaining 50-60% or 70%, depending upon your age, age profile and your income profile and so on. Unfortunately, the answer to your question or Anup's question was, how do one look at budget? You cannot divorce it from an individual situation also. What I might do at my age will be different from what a 30-year-old will do. Similarly, what I would do with if I am in a cushy job with a reasonable salary will be different from what a self-employed person would do, where the income levels can go through ups and downs. So there is always asset allocation which is specific to that investor, which makes sense. But for an average investor, let me put it that way, for an average investor, without trying to duck the question, I would say that a core of your portfolio today, given the valuations and given the risks, have to be in a fund category which is, I would say, dynamically managing the equity allocation for you, because you can't do it yourself. If you can do it, well and good, but most cases people can't do it themselves because emotions take over. And it is very likely that post budget, the excitement levels are so high that emotions will take over, and you will end up doing the wrong thing at some stage. Maybe not now, but maybe 6 months down the line, when everything is going up. We saw that in 2017 what happened. So we will get to that stage. At some stage we will reach that point, and therefore it is important to build the discipline from now on, because you can't build the discipline overnight on the day when everything is going up, unless you have discipline from now. So I would think that today 30-40% of your allocation should be in a fund category which can give you fixed deposit plus 4-5%, and you stick with that, and then you allocate the remaining into equities or debt or whatever, depending upon your own risk profile. Because I don't want, I am quite excited about what I have seen so far in terms of companies declaring results already pre-budget. Budget will only add to that. So I think there is good returns. When I say good returns, not 20-25%, but I would think that 1 year out, 10-15% return from equities is still very much possible. But if you get more than that in a short period of time, then you need to manage risk more actively. If you don't get that return for the next 3 to 6 months, you can keep investing more into equities. I think that's the another way to look at it.
Fair enough. That's a great
I
point.
think
I think at a Scripbox, we've always believed that this is a long-term journey. You cannot have a short-term horizon on this. So,
Right.
as far as the broad India story is intact, and you are investing from a long-term horizon, you need to continue investing, and you need to continue investing in the right set of funds, right? And which is where regular portfolios of long-term wealth edge, or any other portfolios come in, along with the right asset allocation for your stage of life, your as you rightly pointed out,
Exactly.
for your context, right? I think it has to be a mix of two to generate the right outcome for yourself. You're not trying to generate the hypothetical best outcome which was possible there in the market, but something that is good enough and the right for you, right? That and as in one of the conversations, it came out that in place of kitna deti hai, we have to move to kafi deti hai, right? That this is what is good enough for me, right?
Good enough for me is an
yeah,
important
Kafi ka
distinction.
the Kafi ka definition is very personal, right? So it's like, it's very, it's context. It's contextual, and it needs to be personalized, correct?
Yeah. But I think a very important point that Rahul also made out there was that you should not get carried away with recent past, but understand that acceptable return from a long-term perspective is a certain range. And as long as you are broadly close to that range, you're on the right path. There's no need to be adventurous, no need to take extra risk, no need to no need to get carried away in the moment, and continue to make sure that your long-term objectives are never compromised. Yeah. Sorry.
Yeah, in fact, one of the publications did say, like, there's a lot of, I would say, euphoria, maybe rightly, right. I'm not going to comment on whether it's right or wrong, but I guess we need to be cautious always. So there's always a balance that we have to maintain, right? And I think both of you, what you've said of taking into account your personal context and what your personal situation is, and accordingly investing, because asset allocation can also vary based on my risk profile and
Right.
appetite, correct?
Yeah. So there's no single answer for this, unfortunately, but it is very clear that you need to also rely on some mental models, for either made by you, or if you can't make those mental models yourself as to when to
Take
cut
help.
your risk, etc. You get into kind of funds which are doing it for you. So that's the other way in terms of asset allocation.
Sure. I Again, for the audience, if you have any question, please type in comments box. I don't think we've gotten any questions till now. Any other thoughts that you, before we conclude, you would like to add, since we don't have any questions right now?
Yeah, I think from my side, I think the equity markets today, while one looks at valuations and says it's expensive and therefore one should avoid, I think one should not be looking at it at a moment of time. Things are very dynamic. The future outlook always keeps changing. It was looking very bleak in April. It is looking very, very solid now. But things change. I don't see too many risks right now, but that doesn't mean there are no risks. So therefore, one has to try and always be always look at the opportunity and look at valuation in that context. And in terms of asset allocation, like you rightly said, Anup, I think the opportunity is there for investor today to earn significantly higher returns than inflation in equities. When I say significantly, if you're earning 12%, also it is significantly higher than inflation of fixed deposit returns. I think that is how one should look at equities. If you start shooting for straight away 20-25% return every year, you will make mistakes and you will end up with some problems at your hand. I think that's the message I want to give. I think the budget has been good. The probability of making that 10-15% return has improved. I think that is some statement which I can make confidently, and I think that's the message I would like to end with.
Yeah, return expectation always have to be, actually it's sometimes you had a very high return expectation, but the inflation was also very high. So
correct.
It's kind of as interest rates head down, inflation has down, the return expectations have to be accordingly paired, right, on equity market.
Yeah, exactly. I mean, today 11-12% return is a very handsome return, especially with equity taxation.
Correct.
Whereas a AAA debt fund or normal debt fund is giving 5.5%. So fixed deposit is lower, liquid fund is lower. So anything you compare it with, 10-12% is not a return which you should compare with the past and say, okay, this is very low. I think if you keep your aspiration at that number, you will probably end up making 20-25%. But if you keep your aspiration at 20-25%, you might end up with -5. I think that's the point I was trying to make.
Sure. Anything you would like to add, Prateek?
No, I think we're good. Just checking one last time if we have any questions from the audience. Sure, I don't see anything. So great.
Okay,
yeah. Thanks a lot, Rahul.
Thank you so much, Rahul, for the insightful kind of session. And thank you, Prateek, for all the views that we all discussed together. So the budget intent is to go after growth, like the panelists talked about, and we all talked about in this session. So the budget intent is to go after growth and has further strengthened the India story. Investors who are already invested, they can keep adding to their portfolio while maintaining the asset allocation. And investors who have not started should begin building their portfolios. At Scripbox, we follow the best practices to help you realize your aspirations. And nothing happens overnight. So we need to have a horizon of 3 to 5 years. And we believe India's story just got even better, and we all can be a part of it. So thank you all for joining in this session. And thanks again, once again, to Rahul. And we'll end the session now. Okay.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully before investing.